I think we talked about supply and demand as it relates to goods and inflation, right? But important to think about the financial market and supply and demand in terms of how it's developed. When you have 40 years of a massive monetary policy and bonds, interest rates going down secularly for 40 years while stocks go up, obviously that leads to a certain outcome. It's very easy for wealth advisors to not learn anything else or not sell anything else, but collect more and more assets by selling some 60-40, 70-30, process, because that's all that matters, right? It worked because we were in a secular time when that was dominant. But it's completely hollowed out active management. If 68 to 82, like I said, markets nominally went nowhere. Do you think passive investment was a thing from 68 to 82? People think it's like some technological revolution that we've found passive investment. Passive investment never worked until 40 years ago, and it worked because of the Fed, because of monetary policy. And why would you do active management? What's the point? It's expensive. It's not easy. It's hard to scale. Why would you do any of that? Right. So
back to everything becoming easy. Everything was easy. Right?
Yeah.
4 basis points, 60-40 portfolio.
Yeah, and I talk to my investors all the time, and it's funny to a person. No matter who you are, people think they are investors. Everybody thinks they're an investor. Everybody thinks that they know how markets work. You just buy it when it goes down, and you dollar cost average, and over the long run, you make money. And you buy bonds too, and you do some asset diversification, and that balances out. That's probably what everybody's been taught. And people get really confused when you all of a sudden say, wait a second, it's a little more complicated than that. And so, guess what? They're lawyers, and you're not going to go defend yourself in a court of law. You're not going to go do surgery on yourself. There's a certain expertise, and certain people are better at certain things because they have experience than others. Active management matters. Having an edge matters, but all that stuff has been hollowed out. There's almost very few entities that do that anymore, and that do it with meaningful edge. And the value of that all of a sudden is coming to light again. And I think we're going to have really a bull market in active management and broadly, different non-correlated strategies and different types of products. And I think most wealth advisors and most people are woefully underprepared for, what we're going to see in the next 10, 15 years.
I will say this. I think you're right. I think there has been a hollowing out of active management. But what there has been is advancement in certain regulatory laws that allow for like Liquid Alternatives Act, active ETFs. Like the infrastructure has actually evolved and improved over the last 10, 15 years in a way that once active management comes into vogue, you will have a plug and play approach in many respects to do the right things for investors. I think advisors today have more tools at their disposal to do better than they certainly did 20 years ago. Right? Like 20, 30 years ago, you couldn't get a passive exposure to commodities in an easy way. You couldn't get the kind of stacked return fund managers that we have been talking about in this podcast for the last 6 to 9 months, right? Where you get a beta, you put $1 in, you get $1 beta, and then another $1 of alpha, right? So you got capital efficiency within mutual funds, exchange traded funds, and so on. So, funds that include actually proper option overlays that might make sense in this environment. So while indeed the options available are small currently, the infrastructure is great, and those options available are much better and much broader than what existed 20 years ago. So if advisors and investors want to do better, they want to thrive, not just kind of barely hold on but survive, you just need to buckle down, act as if you didn't invest in the last 40 years, find out what people were doing in the 70s, and start doing more of that. We just said there needs to be more of these podcasts. We need to do some wake-up calls here.
Yeah. No, I mean,
we probably have 3 or 4 times as many advisors as the markets will support 10 years from now, right? I mean, it's just been, just like real estate agents, right? I mean, it's just been the most incredible ride, right? As you've got all these tailwinds, your income grows 8% a year, sitting on your hands. And if you decide to build a business as well, then it grows at an even more rapid clip, right? But it's been an easy ride, and I think the next 10 or 15 years are going to drive a lot of those advisors who came into the market maybe in the early 80s and early 90s, maybe into retirement with really nice nest eggs.
Right.
And they'll just generally be fewer and maybe advisors with a different skill set who are better equipped to maybe navigate the more challenging years ahead.
Yeah, but it's been all about low cost, right? Low cost investment, right? Easy, because it's easy, right? Making money is easy. I just think that I think we're going to see a significant move away from that.
It's funny because people call that index investing, though.
Well, exactly.
Right? And it wasn't ever index investing. It was low cost investing,
right,
in a very big concentrated bet. Right? It's a very active bet that investors, especially in the United States, have made in their portfolios, which is a concentrated equity portfolio. It's not even 60-40 anymore. And like, who does that? It really is more like 80-20, I would say now. And then the other 20 is like private equity and all these other like equity-like income products. So, it's just been this view that passive investing is the way to go. And in fact, what's worked is a concentrated domestic equity portfolio that is very low cost. Right? It's just a bet that's really worked, an incredibly risky bet that's worked. And now diversification is back, active management is back. And like Adam said, I think there's going to be a concentrated group of professionals in this space that are going to advisors or, even outsource CIOs and the like that are going to reap the benefits here. And some that are going to get hurt really badly. It'll be interesting to see.